Hello and welcome to our webcast. I'm Amy Pendergrass with Moss Adams, and I'm going to get us started for today's session, Not-for-Profit Accounting and Auditing Spring Update. Before we begin, I'm going to play a brief video.
Welcome, and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you one CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions, which we'll ask throughout today's presentation. To respond to a poll, click the button next to your answer. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget to open a PDF file that you can save to your computer. Don't worry if you can't download your PDF certificate today. We'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. The attendance sheet is available in the slide deck and handouts widget. Please have all group members sign it and send only one sheet per group. Also note that CPE credit can be awarded only to participants registered as themselves and isn't available to participants who view the on-demand version. As a reminder, the presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
And now I would like to introduce today's presenters from Moss Adams, Elizabeth Dollar, Partner, and Etty Goldstein, Senior Manager. Their bios and contact information are located in your webcast console if you would like more information. And now I'd like to turn the floor over to Elizabeth to get the presentation started. Liz?
Thanks, Amy. Welcome, everyone. Hope you all have a snack and some coffee, something for your afternoon or morning, wherever you may be. Today we have a lot to cover and wanted to, kick it off just with an overview of the agenda. Not a ton of new issued accounting standards, but there are some noteworthy items coming up that will impact your financial statements as well as audits and reviews. So I want to talk about that as well as, there's been a significant amount of funding sources and new accounting things as a result of COVID. So we will go through a lot of that during the bulk of this procedure, as well as discuss some accounting industry updates. So hopefully keep you entertained here. At the end, the real thing here, a lot of you to get some CPE, so remember to answer those polling questions. But we really want to give you an idea of what's going on in the industry, really enough to, be dangerous in those meetings of what's coming up. There's a lot of COVID information that's come out, so really reviewing those accounting treatments as now the audits are starting to happen. So you're probably going to get some questions on those. And then, like I said, hopefully we'll have some time for some recent hot topics. So I will turn it over to Etty to get us started on the new accounting standards.
Thank you so much, Liz. So good morning, everyone. We're going to discuss new accounting standards within the next session. The first item is Accounting Standard Update 2020-07, not-for-profit entities. And organizations have had a couple of years to prepare for this standard. And the purpose of this standard is to enhance the presentation and disclosure of contributed non-financial assets or gifts in kind in the financial statement. And on this slide, we show an example of how the change is presented within the statement of activities. With the adoption of this standard, a new line item is added within the support and revenue grouping to show separately the in-kind contributions and or contributed non-financial assets. There are also new disclosure requirements which encompasses qualitative information regarding the monetization or utilization of those contributed non-financial assets, the organization's policy about the monetization of contributed non-financial assets, any descriptions of donor-imposed restrictions, valuation techniques, and the market used to arrive at fair value. And we have a couple of examples addressing those new disclosures. These three examples describe where these contributed non-financial assets were utilized, which in this example was for the homeless shelter program. It also shows the existence of restrictions. And again, in this example, only one item was restricted by the donor, which is the food line item. And the last disclosure is related to the fair value technique, which in this example is the estimated wholesale prices of identical or similar products for equipment and food, and an estimate based on current legal rates for the legal services. This standard is effective for fiscal years beginning after June 15, 2021. So this is a new change coming up for this year's financial statement. And as previously mentioned or shown, it doesn't change the accounting of these transactions, but it does change the presentation and disclosures on the financial statement. And now
Etty, I would just say for that, just remember if you are showing comparative financial statements, it is, retrospective. So for all periods presented. So if you have non-financial assets, you need to, and you're showing comparative statements, you will need to go back and show that information for both years presented.
Thank you. And now we have our first polling question, so I'll pass it to you, Amy.
All right, thank you. So our first question is, does your organization receive non-financial assets as contributions? A, yes, B, no, or C, in rare occasions. And we will give you a few moments to respond. To respond, please click the button next to the answer you choose and hit submit. And if you can't see the submit button, please just enlarge the slide area. And it looks like most have responded. So here are the results.
Oh, the additional disclosures for these contributed non-financial assets will provide helpful information for the user of those financial statements. It definitely further clarifies the policies, purpose, and the use of those assets. So, yeah, I'm glad that people answered yes. So now moving on to the next standard. The reference rate reform guidance that FASB issued in 2020 and amended in 2021 provides temporarily optional experience and exceptions to the U.S. GAAP guidance on contract modifications and hedge accounting to ease the financial reporting burdens related to the transition away from LIBOR and other rates that are expected to be discontinued. And this standard applies to organizations with swaps and derivatives or debt that reference the LIBOR rate, and specifically to contract modifications made after March 1st, 2020 and before December 31st, 2022. And the standard also provides practical experience to receivables and debt, so contracts are accounted for as continuations of existing contracts, and no reassessment of lease classification and discount are required. And with this, I'm going to turn it over to Liz.
Thanks, Etty. So I think, if you're anything like me, it feels like this should be behind us. But I think, as accountants and especially as auditors, we're always living in the past. So you're probably now starting to get a lot of questions about the COVID relief that you may have received. And so in this section, I think there's a little something for everyone here. And we're going to go over there's been a lot of moving parts to many of these relief aids over the last several years, various types of funding and various updates to those funding. So we're going to try to give you a good overview of what has happened here in this COVID era, as well as the accounting for some of these that are really, helpful for the not-for-profit group. So the first one is the Employer Retention Credit, or ERTC. And I think here it starts, I think it's helpful to start by taking a little walk down memory lane, because there's been quite a bit that's gone on since March 13th of 2020, when this was first released. So as a result of the Coronavirus Aid, Relief, and Economic Securities Act, the CARES Act, this provided an opportunity for employers to generate a refundable tax credit used to offset their employment taxes and apply for a refund for any excess credit generated through December 31st, 2020. Then the COVID-19 related Tax Relief Act of 2020 further extended the employer retention tax credit through June 30th, 2021. And it included certain enhancements that were applied starting January 1st, 2021. So that was another change. Then in March 2021, American Rescue Plan Act, or ARPA, was signed by the President, further extending the ERTC through the end of 2021. So we had, a lot of changes just in that first part, but that wasn't the end. Then there was another update in November of 2021 with the Infrastructure Investment and Jobs Act that was signed, which retroactively terminated the ERTC for the fourth quarter of 2021. So it had gone all the way through the fourth quarter. Then they said, no, we're going to stop this at the third quarter of 2021, so this limited the availability of the ERTC to qualified periods between March 13th, 2020 through September 30th, 2021. So on the slide here, that's kind of the background of where this all started and where it technically ends at this point. And the slide shows how employers could qualify, as well as the eligibility requirements in those specific periods. So you can see from the first part of 2020 through the end of 2020, a few things changed when they went to 2021. So employers who had at least 50% reduction in gross receipts, it went to 20% in 2021, as well as, employers with 100 or fewer full-time employees went to 500. And then the credit calculation went from 50 to 70. So there were some significant changes in those time periods. And then I think it's helpful to look back at this, because you may have not qualified in the first round, but then they expanded that qualification in the second round of this. So there might be opportunities there. Also, in 2021, I think ARPA included revisions to the ERTC that applied exclusively to the third and fourth quarters of 2021. One change, for example, specified the credit will be applied against employers' share of Medicare taxes instead of Social Security taxes. And the excess credits will still remain refundable. So that was a change with the third and fourth quarters of 2021. The Infrastructure and Jobs Act retroactively terminated the qualified period for the ERTC to September 30th. However, Businesses that qualify as a recovery startup business may continue to claim the ERTC through the end of December 2021. And employers may still amend returns to apply the ERTC for all qualified periods. So you still have time to go back and amend these returns, even though we're now into 2022. And then for the recovery startup business, that's a little bit different. It's generally a business that meets the following criteria. It started operating after February 15th of 2020 and has an average gross receipts of less than or equal to $1 million. So these were a lot of the businesses and entities that started up to help in the COVID time. So there's a lot there that you can actually go back and still claim. And then the ERTC, how is that related to the PPP? The Tax Relief Act of 2020 retroactively waived the exception for the Paycheck Protection Program loan receipts and allowed you to also claim ERTC. So that was something a lot of folks took advantage of because they had received a PPP loan. They hadn't been able to claim ERTC credits, but now they're able to do that. So businesses who received a PPP loan can go back, claim the ERTC to the extent the business was experiencing partial suspension of operations or if they met the 50% reduction in gross receipts test for the eligible calendar quarters in 2021. The PPP loan recipients may also qualify during the eligible 2021 quarters if they continue to experience partial suspension of operations or meet the 20% reduction in gross receipts test. So there's a lot of nuances here, which is why I think, as a CPA firm, we got a lot of questions about this, and we still do, because there was a lot of money to be claimed here in this credit, which is really beneficial to a lot of organizations. You can still claim this credit, and you have 3 years from the date when the original return was filed, or 2 years from the date the taxes were paid to file an extension, and you do that using the IRS Form 941X. So just wanted to bring that up because there are still opportunities here to continue to claim those funds, and for a lot of organizations that was significant. On the accounting treatment, although it's labeled a credit, the reduction of the payroll taxes is just a mechanism for distributing the support. You recognize the full expense, and the credit's recognized as grant revenue. So that's on the accounting side. So a lot there, and hopefully, those of you who are eligible were able to take advantage of those credits. So, Amy, I think we have our next polling question.
All right, thank you, Liz. So the second question is, did your organization receive any of the available COVID funds? Yes, no, or unsure? And as a reminder, if you would like to receive CPE for today's webcast, you will need to respond to at least 3 of the 4 polling questions. Everyone's answering this one pretty quickly, so we'll just do another 5 seconds here. All right, here are the results.
Great. It looks like the majority of you were able to take advantage of some of these funds, which is great. And like I said, I think there's a little something for everyone here. And next, we'll move on to those of you that are in the higher education space, the Higher Education Emergency Relief Funds, or HERF, as we affectionately refer to it as. You're probably, if you are a higher education institution, likely very familiar with the various tranches of the HERF funds. This slide provides a high-level overview of the various funds. As with the ERTC, there was multiple iterations of how these came out with the various bills, starting with HERF 1 and the CARES Act, where 50% of the funding was used for emergency grants to students and 50% funding was for institutional expenditures. Then in HERF 2 with the Coronavirus Response and Relief Supplemental Appropriations Act, same amount of funding to be spent on students, but increasing the funding for institutional expenditures. Then we had HERF 3 with the American Rescue Plan, introducing the concept of lost revenue. So what didn't you get while you were not able to be having in-person, school, or and then there was, some additional guidance around what expenditures could be charged to the grants. And then finally, the last round just closed. Actually, institutions had to apply for the funding under the supplemental support under the American Rescue Plan. Those applications were due at the beginning of April. April 4th was the deadline, and the priority there was given to community colleges and institutions with the greatest unmet needs in the pandemic. So obviously a lot going on with the various types of funds. And now I think really what this is the accounting update. I think now that the deadline has passed and a lot of these funds have been received, you're now getting questions about them and probably from your audits, and what does the audit and accounting look like? So the accounting treatment for these HERF funds falls under ASU 2018-08 grants are conditional when both a right of return and a barrier to entitlement exists. So the HERF allotted funding in two groups under each of the three relief packages, so students and institutions. Under HERF 1, higher education institutions that received HERF 1 funds can use no less than 50% of the funds received on grants to students. The requirement to spend at least 50% on student grants generally is considered to be that barrier under FASB 958. So that's how you fall under the barrier. In addition, if you're a GASB entity, the spending requirement is considered to be an eligibility requirement under GASB 33. So under this approach, the institution would only recognize revenue from the institutional portion of the HERF grant to the extent it incurred and recognized revenue from the student portion and met all the other grant requirements. So it wasn't exactly easy to figure out, and I know we held a lot of town halls on this subject because the guidance was consistently changing, I would say, throughout this time frame when the various funding was getting released. HERF 3 essentially follows the same model as HERF 1 because no less than 50% of the funds were designated to grants for students. So those two, HERF 1 and 3, essentially the same rules, but HERF 2 operates differently. So you have to be looking at the specific grants that you received, and that's how you follow the accounting. So where HERF 1 and 3 required no less than 50% to be spent on the student portion, HERF 2 requires the educational institutions to provide the same amount in grants to students that they were required to provide under HERF 1, but it's silent regarding the student versus institution and focused on a pure dollar minimum to give to students. So in general, the funding amount for HERF 2 is greater than 1, making the institutional portion larger part of the funding, and then, having to give a little bit of subjectivity to the allocation of that. So that's a little bit of a unique difference in HERF 2. There is a lot of guidance out there on this topic, and the Department of Education has done a pretty good job of continuing to get out frequently asked questions. So if you're still unsure about this, there is a lot out there now as we kind of start getting into this period of where the audits are happening. Another unique accounting issue in this area It allows institutions to apply funding to eligible expenses and lost revenues back to March 13th, 2020, which is the day the national emergency was declared. So even though the funding allows for expenses from a previous year to be applied to it, the revenue wouldn't be recognized until the year the grant was awarded to the institution. So as a result, the revenue not potentially aligning with when the funds are used, it's possible that revenue reported by the institution may not align with the expenditures reported under the schedule of expenditures of federal awards. So that was definitely a unique situation, and as you go into your audits, you may have, expenses that are from a previous period, not aligning with that revenue of the grants that you received. So in saying all of that, what I would encourage, and what we tell our clients is the importance of documentation. It's really important for institutions to document the strategies they used in accounting for these, in the allocations of the awards to the students versus the support for the institutions, the evidence behind those strategies. So what do you have to show your auditors on how you made these decisions? Explanations of how the strategies are in accordance with the public health guidelines, manner and extent of direct outreach to financial aid applicants, explanations of how you spent, amounts spent on these activities were reasonable and necessary given the unique needs and circumstances of the institution. Every institution is going to have a different and unique situation. So how did you document and assess that in your specific situation? So this documentation will be critical for your single audit. In addition, the Department of Education is considering collecting more information on the implementation of these requirements for their annual reports. You may get questions there. But again, a lot of things happening over the course of the year, and with the guidance being different for the different tranches, the documentation is going to be key. So hopefully you've kept a good track of how all these decisions were made. And for those of you that aren't higher education institutions and maybe in this category, there's the Shuttered Venue Operators Grant, the SVOG. And again, this was application-based. Eligible applications may qualify for grants equal to 45% of their gross earned revenue with max awards of $10 million. So there was a lot of money given out to these various venues that weren't able to be open in the COVID health restrictions. So there's a lot of funds out there now and a lot of things to consider as you start getting into your audits for these SVOG grants when they were received. So under the SVOG, since entitlement to the payments from the Small Business Association is considered upon having incurred eligible expenses, there's deemed to be a barrier to entitlement. So again, you're falling under that, do we have a barrier and a right to return? Also under SVOG, the noncompliance with the terms and conditions is grounds for the SBA to recoup the funds, so there's deemed to be a right of return. So based on these two facts, SVOG would be considered a conditional contribution under ASC 958-605. So there you fall into, again, this guidance of the conditional contribution. For each nonprofit that receives SVOG, you need to evaluate its individual facts and circumstances, determining the extent to which the conditions have been substantially met at a given reporting date. So because you have this conditional contribution, the contribution revenue would only be recognized to the extent that the eligible expenses have been incurred at that date. So payment amounts received that exceed the recognizable contribution revenue would be reported as a refundable advance in the liability section of the Statement of Financial Position. This is based on the fact that entitlement to the funds is conditioned on the eligible expenses that are expected to be incurred in subsequent accounting periods. So you don't recognize that revenue until those expenses have been incurred. To the extent that the nonprofit determines the conditions have been met and recognize the contribution revenue, it will also need to consider whether there are restrictions imposed by the government on the use of these funds. So do you have is this restricted contribution? Since under SVOG, payments can only be used for eligible expenses as defined by the SBA, these funds would be considered to be donor restricted. Due to the relationship of the conditions and the restrictions, meaning both are hinged on eligible expenses being incurred, these would likely be satisfied simultaneously. However, each nonprofit entity has to make an assessment for the specific facts and circumstances. But most likely you would see those, once you have that eligible expense, that restriction has been met. If a nonprofit deems the condition and restriction are satisfied simultaneously, the entity would record the contribution revenue as net assets with donor restriction with a reclassification to net assets without donor restriction to reflect the satisfaction of the donor restriction in the statement of activities. You could also have elected to have the simultaneous release accounting policy option. So you could end up reporting that contribution revenue directly as net assets without donor restrictions because of that simultaneous release. This is all for nonprofit organizations. So if you're kind of listening to this and you are for-profit, because there were for-profit businesses that did receive SVOG grants, this isn't the same, obviously, as this is nonprofit accounting. So there is a technical Q&A out there for guidance options for for-profit businesses as well, because that accounting is different. And I think the biggest thing is that, this goes on your schedule of expenditures of federal awards. So for many nonprofit organizations, they never had a federal award source or a single audit, uniform grant audit required, but this does have an assistance listing number. It's 59.075. So the SVOG is subject to single audit under the uniform guidance if the nonprofit entity receives funds, has federal expenditures under the fiscal year of $750,000 or more. So if, for many organizations, their grant was much more than that $750,000 threshold, and therefore they're going to be required to have a single audit for the first time. So, that's a big deal for a lot of organizations and something that they may not have gone through. So understanding that while you're going through and spending some time getting your policies and procedures updated and documenting what you're doing is going to be very important for when that audit happens. We do have an entire webcast coming up on May 5th on preparing for SVOG audits. So if this is something that is applicable to you, we're going to spend a whole nother webcast on it just to help get you prepared for that audit situation. So now I'll turn it over to Etty to talk about provider relief funds.
Thank you. So provider relief funds, definitely this continues to be a hot topic for nonprofits. And in January 2022, HHS distributed $2 billion of provider relief funds payments to providers in 3 phases of general distribution, and various targeted distributions have been already paid. So a lot of funds have been already distributed related to the provider relief funds. And one of the most significant items that have required a lot of attention has been the reporting periods for these funds. And the portal to report period 2 was open until recently. In March, it just closed March 31st, 2022. The portal to report period 3, it opens on July 1st, 2022. So this one is coming up. This will be the next reporting period. The portal to report period 4 opens next year on January 1st, 2023. And the portal to report period 5 opens on July 1st, 2023. So it's also next year. The provider relief funds are being recognized similarly to the ones that Liz went over, these are recognized as grant revenues in accordance to ASU 2018-08, as measurable barriers are met, which is consistent with the recognition of grants that had some donor restrictions. And this table shows the reporting total period, which goes from period 1 to period 5. It also shows the payment received period and the period of availability, which always starts with January 1st, 2020. And it is crucial that the organization ensures that populations include all activity in a given period of availability, regardless of when they were recorded for financial statement purposes. And for those that have single audits and need to prepare a schedule of expenditures of federal awards, they must follow the schedule included in the compliance supplement for these funds. And this table shows that for years ended before June 30, 2021, the provided relief funds were not included in the schedule. And expenditures and lost revenues included in the Period 1 report that was already submitted to HRSA had to be reported for fiscal years ended June 30, 2021 through December 30th, 2021. Expenditures and lost revenues included in the Period 1 and Period 2 reports that were already submitted to HRSA are also or should be included or reported for fiscal years December 31st, 2021 through June 29, 2022. For expenditures and lost revenues included in Period 2 and Period 3 reports to be submitted to HRSA are to be reported for fiscal years ending June 30, 2022 through December 30, 2022. And expenditures and lost revenues included in Period 3 and Period 4 reports that are to be submitted to HRSA shall be reported for fiscal years ending December 31st, 2022 through June 29, 2023. And we're still waiting for the 2023 compliance supplement to address the schedule for fiscal years ending June 30, 2023 and after. So as you could see in the last two tables, the period differ between the reports to be submitted in the portal, the period of availability of the funds, and the schedule of expenditures of federal awards. So again, it is very important to pay close attention to the dates because this program is not as simple as other programs that we're used to deal with in the past in regards to federal grants application. Also, a new grant is coming up for nonprofit organizations, and this is related to energy efficiency materials. And these funds are available to spend on materials used during the installation of systems that result in a reduction of energy or fuel, and other products or equipment like roofs, lighting, windows, doors, HVAC systems. And the purpose of this grant is to help nonprofits to save money on updates and help those organizations spend more on their mission. So the grant will be managed by the Department of Energy, and it is estimated that the application opening date is within the first quarter of 2023. So please stay tuned as more information becomes available regarding when and where to apply for this fund. And Amy, it looks like we have a polling question, so I'll pass it up to you.
All right, thank you. So our third question is, what is the biggest challenge for your organization? A, transitioning to remote working in most instances. B, reduction of revenues impacting operations. Or C, loss of employees. And for those of you that would like a copy of today's slides, you can download them from the folder that says slide deck and handouts. We will also be sending the slides via email tomorrow, along with a recording of this webcast. All right, so most have responded, so here are the results.
The loss of employees is the most significant one for this response. And this is very consistent with what we've seen in the industry. Definitely COVID and current market conditions have had a significant impact on every organization. And we have good information towards the end of this presentation that will be beneficial to you in regards to this topic. So continuing with new standards, there have been several SASB issued that may have a significant impact on the financial statements. And as noted on this table, these are mainly related to the auditor's report, responsibilities, some definition of materiality, audit evidence, accounting estimates, and risks. So within the next few slides, we will discuss the most significant changes to this SASB. So starting with SASB 134, this is related to changes in the auditor's report. And the new standard changes both the form and content of the auditor's report. The opinion paragraph will become the first paragraph followed by the basis for opinion. And the basis for opinion will be included even if the report is unmodified. It also enhances the reporting related to going concern and the auditor's responsibility by defining what is reasonable assurance, defining material misstatements, stating that the risk of not detecting a material misstatement resulting from fraud is greater than the risk resulting from an error, and describing the requirements of communicating with those charged with governance. So here on this slide, you can see visually some of those changes that we discussed on the last slide, including the movement of the opinion and basis for opinion paragraphs. The placement of emphasis of matter and other matter paragraphs will no longer be required to follow the opinion paragraph. And rather, the placement depends on the nature of the information being communicated and the relative significance of the information to intended users compared to the other report elements included in the new reporting. And the form and content of the other reporting responsibilities section will vary depending on the nature of the other reporting responsibilities. So hopefully this will make a little easier and better for understanding of the user of those financial statements. And the other changes included on SASB 134 will provide a more transparent and direct communication between the auditor and the auditee. For example, the planning communication with those in charge of governance is modified to include the significant risk identified by the auditors. And any emphasis of matter and other matter paragraph requires a separate section in the auditor's report with the specific supplementary information or required supplementary information headings, rather than all just being part of the other matters paragraph. So it just makes it clearer when we have other matter or emphasis of matter paragraphs. Another change in SASB 134 is related to the amendments made to the various AUC sections. And this is to include few requirements to ensure that the auditors are focusing on disclosures at the right time. So for example, the AUC 315 now includes a requirement that as part of the engagement team's brainstorming session, the auditor has to consider the risk of material misstatements related to the disclosures. So new disclosures may be a result of the entity's activities, like a significant business combination in the period under audit. And disclosures for which obtaining sufficient appropriate audit evidence may have been difficult in the past. And or disclosures about complex matters, including those involving significant management judgments. So this should be now considered and documented in accordance with this new standard. And as mentioned previously, SASB 134 also enhanced disclosures related to going concern. The going concern, which is AUC 570, requires a separate section in the auditor's report when substantial doubt exists. And this will be presented under the heading Substantial Doubt about the entity's ability to continue as a going concern. And this will be presented immediately after the basis for opinion of the auditor's report section. So if substantial doubt has been alleviated by management plans and adequate disclosures have been made, the auditor may include an emphasis of matter paragraph to making reference to management disclosures. And management is responsible for preparing the financial statements. Management is still required to evaluate whether there are conditions or events considered in the aggregate that raise substantial doubt about the organization's ability to continue as a going concern. And of course, the auditors are still responsible to conclude whether in their judgment there are conditions or events considered in the aggregate that raise substantial doubt about the organization's ability to continue as a going concern for a reasonable period of time. So therefore, we can note that the changes are related to the disclosures on the financial statements and the auditor's report, but there are no changes on management or auditor's responsibilities for this new SAS. For SAS 135, Omnibus 2019, this one is intended to more closely align Auditing Standards Board guidance with the Public Company Accounting Oversight Board standards, and primarily by amending communications with those in charge with governance, related parties, and consideration of fraud and financial statements audit. And the new amendments require additional communications about the auditor's view relating to the organization's significant unusual transactions and about the potential effects of uncorrected misstatements on future period financial statements. There are also some additional communications for related party transactions and some additional inquiries of management that we will need to consider fraud due to unusual transactions. So again, as mentioned previously, these new requirements are enhancing the availability and communication of significant information for management and users of the financial statements. The next one is SAS 137, and this one refers to other information. And the other information is defined as a financial or non-financial information including entities' annual report. And it's important to clarify also what an annual report is, and that's defined as a document typically prepared on an annual basis by management for the purpose of providing owners with information regarding the entity's operations and financial results set out in the financial statement. And this will contain or incorporate by reference the financial statements in the auditor's report. And this can also be available to the public, of course. So the SAS indicates that the other information will typically be prepared on an annual basis. However, this may not be true, because thinking about nonprofit organizations, there may be an annual report only every couple of years, or when kicking off a new significant campaign to distribute to potential donors. So this annual report will be a variety of different things. But one of the things that would not be considered an annual report under SAS 137, and this is very important to take into consideration, is the preliminary official statement or an official statement issued to sell tax-exempt bonds. Those are not considered an annual report under SAS 137. And if the annual report is available before issuance of the audit report, the auditors are required to read and check that other information for inconsistencies with the audit report. And it will be required to add an other information section to the auditor's report, a representation to the management representation letter, and information in the communication with those charged with governance. However, in the case that the annual report is not available before issuance of the audit report, the auditors will still read the information when available and check for inconsistencies with the audit report. And then still add the representation letter to the management representation letter, and add communication with those in charge with governance. However, there won't be an other information section in the auditor's report, and a consideration to reassess subsequent event procedures will be also needed. So, in summary, the difference of having the annual report available before or after the audit report is issued will be the other information section in the auditor's report and a reassessment of subsequent event procedures.
Yeah, Etty, I think that one, just a little clarification. This is confusing even for auditors, I think, in terms of what constitutes the annual report in the first place, but then what financial or non-financial information is included in the entity's annual report. I know a lot of nonprofits put their audited financial statements on their website. That doesn't fall into this at all. That's fine. That continues to be fine. A lot of annual reports put financial information like this is the amount of revenue contributions we had, or this is the amount of grants we made, this was our investment, and have been doing that for years. As long as that doesn't make reference to our financial statements and our auditor's report, that's still fine and does not fall under this standard. It's really when your annual report includes pages of the financial statements and says our auditors were X and their report can be found here, and maybe then points to the link to the website. If you just say you can find our audit here on the website and have a link, but it doesn't talk about who your auditors are or any of the information there, then you're scoped out. So this is something I would say probably your auditors should be having this conversation with you, and if they're not, I would suggest you have this conversation with them, because it's not just the inclusion of the balance sheet and the P&L in the report. Even if it's in the same format, if you're not making any reference to the audit or to your auditors, it doesn't matter. It's your financial statements. It's really about, for an auditor, if you're making reference to our audit report and that we did audit your financial statements, then that scopes us into making sure that there's not inconsistencies between those two. So it's a really kind of a fuzzy line, but I would have those conversations with your auditors early so that it doesn't end up holding up the issuance of your audit.
Right, and just because we also will need some time to add that those additional sentences on the report and the rep letter if it's applicable. Okay, so moving on to the next one, this is SAS 142. This is related to audit evidence, and the purpose of this is to evaluate whether sufficient appropriate audit evidence has been obtained from the information used as audit evidence. So the SAS 142 will enhance the definition of key concepts related to audit evidence, what is considered appropriate and sufficient audit evidence, and it is effective for audits of financial statements for periods ending on or after December 15, 2022. The next one, which is SAS 143, is related to auditing accounting estimates and related disclosures. And the purpose of this task is to obtain sufficient appropriate audit evidence about whether the accounting estimates and related disclosures in the financial statements are reasonable. It will enhance the definition of key concepts related to estimates, uncertainties, management bias, and outcomes from those estimates. And it is effective for audits of financial statements for periods ending on or after December 15, 2023. And this will just significantly impact mostly the audit side and maybe some of the requests that we will have during those audits. And this last SAS 145, this is related to the understanding of the entity and its environment and assessing the risk of material misstatements. So the purpose of this task is to enhance the requirements and guidance related to the auditor's risk assessment. So particularly related to obtaining an understanding of the entity system of internal control and assessing that control risk. And the standard also has a new requirement to separately assess inherent risk and control risk. And this will be effective for audits of financial statements for periods ending on or after December 15, 2023. And Amy, it seems that we have our last polling question, so I'll turn it to you.
All right, thank you. So the last one is, do you expect the financial statements users to better understand the new auditor's report? A, yes, B, no, or C, no changes are expected. And then also, once you've completed all CPE requirements, you will be able to download a PDF of your certificate from the CPE progress window. Since we're short on time, we're going to move this one along pretty quickly, so we'll give it another few seconds here. All right, here are the results.
Oh, good. I'm very fun. Definitely the changes are directed towards the enhancement of the presentation and information included on those financial statements. So my personal expectation is that these changes will help users further understand the auditor's report and the financial statements as well. Now, I'll turn it over to you, Liz.
Thanks, Etty. Yeah, so we're just about the time, but we'll go through a few final things to consider as you're going into this. I know earlier one of our polling questions was, regarding what's been impacting you, and the most of you, it was loss of employees. And I think that all industries are facing this issue at the moment, and people are hard to find and keep. So really, when we're talking to our clients, it's really about what, have you reassessed? Now might be a good time to kind of consider, are your policies up to date on what remote working, can you hire people in a different location? What are you able to do to potentially, kind of do something different in this time where all of a sudden you have, holes in the department? And we've had a lot of clients come to us in terms of doing, a consulting on is this the right fit for the organizational structure? Were all the roles that we had that are vacant really necessary, or is there an opportunity here to maybe restructure or look at things differently? But I think, also from an audit standpoint, we just consider, hey, are your internal controls still good? Because you've got people that are gone that are, might not have been replaced. So revisit those policies and procedures and really think about education as well for those, because a lot of people are moving into the nonprofit sector from for-profit at this point in time. And so you might have to do some education to consider that. There are also some market-based solutions. I think now might be a time to consider outsourcing some of these options. But in that, making sure that, again, you're having an appropriate safeguards for that. So if you've outsourced, your accounting or payroll, do they have, internal controls reports or SOC reports? And are you looking at those and making sure that there's no internal control issues there? So just consider things as times are changing. And then, just kind of think about your board. Boards have been more engaged right now. Are you getting the most out of them and really communicating upfront with your auditors just to take successful audits with all of these changing things going on in the world? So I know there's been a lot of questions coming in. We will get back to everyone who had a question. So I appreciate that. But Amy, I think, is going to wrap us up here.
All right, thank you. Thank you, Liz and Etty, for a great presentation today. And also to our audience, feel free to reach out to either of them if you have additional questions. And we do have some upcoming webcasts that we wanted you to be aware of. We have the Prepare for the SDOG audit on May 5th and our spring not-for-profit tax update on June 28th. And we also want to remind you that we have a lot of resources available on our website. We have linked a few of them directly in your console, so definitely check those out. And if you've met all CPE requirements, your certificate is available to download now in the CPE progress window. We will email a copy within 3 weeks should you have difficulty downloading it now. And finally, here's a link to an online survey where you can provide feedback for today's presentation. And thank you for joining our webcast. We hope you'll join us again next time. Take care.